All right. Today is Thursday, October 7th. This is a recap for the stock market activities today. Of course, I have my conditions for market bottom. Number 1, a top in the US dollar. Number 2, a top in the 10-year yield. And number 3, climbing the wall of worry. We have done a lot of climbing as of late when it comes to the debt crisis, the China front, but perhaps the unavoidable item in the wall of worry that you cannot climb is the issue of tightening the monetary policy, the upcoming tapering, and perhaps the abrupt hike in interest rates. Now, the market rallied higher today. The question is it a bottom? Is it not a bottom? For now, these conditions were not met, at least for now. But we're about to get a lot of clarity here from the upcoming jobs report that is about to come out tomorrow morning. For now, the market is rebounding higher on the heels of technical conditions that we discussed in last night's video. On top of that, we have a semi-agreement for now when it comes to the debt crisis. And all what they have done for now is kicking the can down the road all the way to December, meaning the market rejoiced today that the issue will be revisited once again in a few weeks. And with that, in focus tonight, we will talk about the inflation crisis and the labor shortages. We will also talk about Taiwan and the hidden risk in Taiwan that nobody's paying attention to, at least for now. And lastly, I want to talk about who should be leading the Federal Reserve right now. Hint, Mohamed Al-Arian, and I will show you why. But let's start with the inflation crisis and the labor shortages. In the morning, we got the report, the weekly jobless claims, and they went down. So we have two indicators now, the ADP report and the weekly jobless claims, indicating that the report we're about to receive tomorrow should beat expectations easily. And the expectations are for 500,000 jobs created in the month of September. Unless the cooks over at the BLS do some funny business, the number should be a little hotter than the expectations. And this will push the Fed closer to tapering and tightening the monetary policy. But perhaps the surprising element here is the fact that layoffs went higher in September. We're losing jobs as we're creating new jobs. What does that mean? It means we have existing employees either getting fired or leaving the job, while we're creating new jobs in leisure, hospitality, and other vital sectors of the economy. And this means that labor has the room to wiggle and look for other jobs in other industries, perhaps in other locations. And therefore, any pressure on labor from employers or from the government, meaning jab mandates, could alienate labor to quit their jobs and move somewhere else and look for another job. And we now know that the jab mandates are responsible for the increase in the number of layoffs. Layoffs last month were led by companies in the healthcare/products sector, with 2,673 announced cuts since the Pfizer jab received full FDA approval. Many healthcare facilities have implemented jab mandates. Healthcare is facing an enormous talent shortage. Andrew Challenger, Senior Vice President at Challenger, Gray and Christmas, he said other systems are facing walkouts or fringe of unvaccinated staff, further burdening the worker shortage. In some cases, a lack of staff leads to the closing of entire units, causing involuntary job loss. Ongoing strains in the supply chain are hurting the labor market. Industrial goods manufacturers announced 2,328 layoffs in September, while warehousing businesses planned 1,936 job cuts. There were 1,679 job cuts announced in the services sector. But the rise in layoffs was dwarfed by an explosion in planned hiring, in part as retailers gear up for the holidays season. The Challenger report showed companies announced plans to hire 939,790 workers compared to only 94,004 in August. Now, good luck finding employees, by the way, to fill all of these jobs for the upcoming holiday season. It's not going to happen, which means wages will have to be hiked up higher. Of course, this is assuming that younger workers will abide by the jab mandates. But even if they do, wages will have to go higher, significantly higher. What does that mean? Prices will go higher for you and I, the end customer, the consumer. We will pay more this holiday season. We also have a problem with daycare workers. The shortage in daycare workers has ripple effects across the economy. Daycare costs, regardless of the aid from the government, remains a high burden for families. a massive expense that they have to deal with. And therefore, we're seeing mothers choosing to stay at home, perhaps taking some online courses, planning to join the workforce at some point in the future. But for now, they're choosing to stay at home, take care of the kids, and depend on one wage earner in the household. So there is no end in sight for the labor shortage, and the labor shortage is contributing to the inflation crisis to become even more intense and more burdensome to the average consumer. We also learned from small businesses that they have open positions all over the place. They're looking for workers. They have the highest number in open jobs in years, yet workers are not showing up. One must ask the question here, what is the wisdom from all of these jab mandates when we have a severe labor shortage to begin with? For example, in the city of LA, my former hometown, which I left, and I'm glad that I left, has a draconian mandate. Perhaps the most draconian mandate in the entire country, barring the unjabbed to enter any indoor establishment, from restaurants to gyms to shopping centers, entertainment venues, and personal care establishments. One must question the wisdom and the reasoning behind such draconian mandate. What is the end goal here? We have a severe labor shortage, and this experiment, to begin with, already failed in New York City. We have the news that 11 out of 15 New York City restaurants were not enforcing the jab mandates. On top of that, we have all of these ugly scenes pitting people against each other. And we have restaurant workers, food servers, already underpaid and overworked. And now they have to deal with enforcing these mandates and checking people's cards. It is not their job. And therefore, we're seeing these ugly scenes of servers getting attacked and assaulted all over the place. Now, is this an environment to attract restaurant workers? Of course not. And we know that the majority of small businesses in the country are restaurants. And restaurants are having a hard time finding labor, the highest number of open positions in years, yet the labor is nowhere to be found. These draconian mandates are costing restaurants labor, customers, and income. They're already under massive pressure. They lost a lot of money. Some of these small businesses are hanging by a thread. They did not receive any aid from the government since the PPP loans program. Businesses down to begin with, and now we have draconian mandates that will add more pressure on these businesses, and we will see small businesses in America falling apart. What is the wisdom of such draconian mandate when the sheriff department is not going to enforce it anyways? Am I going to ask my staff at the restaurant or the bar to check for IDs or jab cards and decide who gets in, who gets out, and they deal with the chaos and perhaps risking getting assaulted and then end up suing me, the business owner? It is a massive hassle here, and it is not worth it anymore to have a small business in America. Between the labor shortage, the wage inflation, the supply chain shortages, higher taxes, jab mandates, how do you operate businesses under these conditions? What is the point of such draconian mandate when we now know in California we had a bigger wave of infections this time around, when we have over 71% of the entire population of California fully jabbed? Yet we had a bigger wave this time around than the first wave when we had 0% jabbed. What is the point of such draconian mandates when we know that this is not the right approach to ensure a successful reopening of the economy? We already know that. We reopen with the jabs and we got a bigger wave anyways. There is no tracking devices that tells us, even the jabbed, whether our antibodies are active or not. There is no way to know. Your card might say that you have 2 shots, but how do you know that your antibodies are active right now? There is no way to verify that, and therefore, we're not going to achieve anything from these mandates but hurting small businesses and destroying the economy. Here in our state of California, we have the elite, the VIPs, the Hollywood elite, up in the hills in Malibu, demonizing the unjabbed every day, over and over and over and over again. Matter of fact, we have Jimmy Kimmel, for example, saying that if the unjabbed go to the hospital, to the ICU, deny them service, deny them medical care. Who is he talking about, by the way? We're talking about young, brown, and black people, black and Hispanic people. Those are the majority of the unjabbed in LA County. So we have privileged Hollywood elite, the likes of Jimmy Kimmel, for example, who can have doctors on demand hand, wagging his finger against young black and brown people and saying you should be denied medical service. And we're having all these troubles because of you. Well, if you want to deny them medical service, then you don't care about them. It's not about saving lives. You're basically saying let them die. So let them die. Stop mandating these draconian measures because you want them to die, right? It is not about saving lives to begin with. It was never about saving lives. This is the nature of sadistic authoritarianism and control. That's all about it. And it is costing the economy a dire cost of prolonged inflation and labor shortages, which will hike up wages higher. It will hike up the prices of the end consumer across the board. And the inflation crisis doesn't stop here with the labor shortage. We also have housing prices surging out of control, pricing the majority of families out of the housing market. Matter of fact, the median home price in California is now $800,000. And of course, for $800,000, I guarantee you, you're not going to get a decent house in a decent neighborhood. What is the median income, by the way, in the state of California? The answer is about $32,000. So housing prices are now 25 times the average median income in the state of California. But the Federal Reserve says, where is inflation? I don't see the problem here. It's going to be transitory. They're destroying the fabric of this country, and they are pricing out the majority of families out of the housing market. Yet the Fed continues to buy a minimum of $40 billion in mortgage-backed securities every single month. Does it make sense at all? What is the point here? We have the highest prices ever, the biggest housing bubble ever. Why do they continue to inflate this bubble bigger and bigger and bigger? What is the wisdom behind that? The inflation crisis deepens. And now we have companies running out of truckers and facing a supply chain nightmare as chips are stuck at ports not delivering goods. They need more goods. Walmarts, the Home Depots of the world, right now they're sharing truckers and now thinking about starting their own shipping logistics, meaning that these companies will have to endure the extra cost of buying or building and operating these ships, and therefore this crisis is stagflationary in nature. All of this extra cost from companies across the economy moving on to vertical integration by starting their own supply chain routes in-house, be it trucks, ships, or even airplanes. All of that extra cost will have to be passed down to the end customer, regardless of the growth in the economy, and therefore this is stagflationary in nature, because regardless of the growth, even if it goes down and the demand slows down in the economy, that extra cost is endured by these companies, and they will have to pass it down to the end customer regardless. And yes, container shipping prices are dropping like a rock, not because the demand has slowed down or the supply has caught up with the demand. It is due to the fact that there are no containers available. We're running out, and therefore prices are dropping like a rock. But the crisis is still here, and it will continue to get worse and worse and worse, so long as the Federal Reserve, the central bank of the world, continues on this path of the reckless policy of flooding the financial system and the economy with unneeded liquidity, creating inflation all over the place. And the energy crisis is worsening. Prices are rising across the board, from crude oil to heating oil to natural gas, all rising higher. And I have not seen such a relentless rally in crude oil prices since the 2006-2007 rally. Even as the dollar continues to rise higher, oil prices have been resilient, and they continue to rise higher and higher and higher. And now we have questions, even from the economists, asking, is the world going back to the 1970s during the great stagflation crisis? Even used car prices, the transitory one, are now rising higher again. Dealers pay record prices for used cars, reversing a trend that pointed to an easing of inflation. So here we go again. You thought used car prices went down, hence inflation is transitory. Powell is right. End of story. Not too fast. Used car prices are rising higher again. Why? Because, folks, we have to go back to the principles and the cores of economics from the legendary economist Milton Friedman, who said that inflation is always a monetary phenomena. There is no such thing as supply push inflation. So long as the Fed continues to print money out of thin air, flooding the system with unneeded liquidity, aka the cocaine operation, for the sole purpose of propping up assets prices higher, aka stocks and real estate, to make the rich richer, inflation is going nowhere. it will continue to grow higher and higher and higher. We are now learning the cost to the average American from this great inflation crisis, which the Federal Reserve and Chairman Powell say it is good for us. Inflation is good for the economy, really, because here's what's going on, by the way. The real cost of inflation to the average American household, an extra $175 a month. Now, this is a conservative figure, by the way. You and I know that it is way more than $175 because if you signed a new lease or renewed your lease recently, if you are renting a place to live, your rent went higher by a minimum of 10 to 20%. So forget about 175. It is way more than that, but we will play with this number. Here is from the average American. I used to spend $70 a week, but all of a sudden this summer, I noticed that I couldn't leave the store without spending at least $120. Like millions of Americans whose income has not kept with inflation, up 5.3% in August compared to a year ago, Allison and her family are feeling the pinch of rising costs of living and giving up some things just to make ends meet. Her family is scrimping now. There are no more splurges, like going to Home Depot to buy an extra plant or eating out. This is the cost of inflation. And by the way, here is the conservative figures. And as you can see, goods, prices went higher across the board, be it from Pepsi cans, to chips, to cheese, to dishwasher soap, rising 100% year over year, milk, meat, and of course these are conservative figures, by the way. You and I know that the prices of meat went way higher than last year and the year before. For example, ground beef prices at Costco went higher from $17 to $23 a piece. The American consumer is getting killed by this inflation. But the Fed says, trust us, rest assured, inflation will be transitory. And all of what we're doing here, pushing inflation higher and higher and higher, is because we need to create jobs. It's all about maximum employment, our Fugazi mandate. And we must ask the question now, is there any correlation at all between the creation of jobs and the cocaine operation of printing money out of thin air and buying bonds and mortgage-backed securities to the tune of a minimum of $120 million. That's nothing. $120 billion a month. What is the wisdom behind that? Our employers or even labor saying that perhaps if the Fed buys another $120 billion a month in bonds and mortgage-backed securities next month, I'm going to create a job or look for a job. Of course not. There is no correlation at all. We even heard from former Fed President, the New York Fed President Dudley, and he issued a dire warning here, saying that perhaps the Federal Reserve is fighting the wrong inflation war. The central bank's approach would have made more sense a decade ago. Bill Dudley says regarding the current strategy of the Fed, this strategy isn't necessarily well suited for today's circumstances. Inflation is already well above 2% target, and the Fed's index of common inflation expectations indicates that inflation expectations are very close to the Fed's 2% inflation objective. This in turn raises some important questions. How long will these inflationary pressures last? How far is employment from its maximum level? And what will happen with inflation when it gets there? An extremely important question. The Fed says, yes, we know inflation is rising out of control, but we have to continue to do what we're doing right now to achieve maximum employment. And Dudley says, by the time you get to maximum employment, where would inflation be? Will it be at 5, 6, 10, 20%? And is the price worth it? A faster pace of tightening would come as a shock for financial markets and could risk tipping the economy back into recession. That is the danger of fighting the wrong war. The Fed will realize that their policies are misguided, but they will realize that when it's too late. They will realize that there is no correlation at all between their policies and the creation of jobs. The only correlation between their policies is with inflation, pushing inflation higher. When they realize that, tapering assets purchases will not do the job, and the Fed will have to hike up rates abruptly, and this will be indeed disruptive and destructive for the markets and the economy. But perhaps the most important statement today came from Cleveland Fed President Mister, and this went totally under the radar today. The market did not pay attention at all to this very critical statement from Mister. She says inflation has already cleared hurdle for rate hike. Pay attention now, rate hike. But the employment criteria not met yet, meaning maximum employment, further, substantial, further progress, whatever it is. Cleveland President Mister says we will not reach maximum employment until later next year. And therefore, we go back to Dudley's question. Where would inflation be later next year if it is already white hot right now, disrupting the entire supply chain globally? Can you imagine how bad the inflation crisis would be later next year if the policy doesn't change at all? And perhaps the most important statement here is inflation, the current level of inflation, already meriting raising interest rates, not just tapering, but raising interest rates. And the only thing holding the Fed right now is waiting and waiting and waiting for maximum employment, which will never happen. And again, the Fed will get caught with their pants down, and they will destroy the market and the economy. And even this guy's warning now. Remember him, Slimy Mnuchin? Slimy Mnuchin now says that the inflation risk is higher, and he sees 3.5% treasury yields in the horizon. Can you imagine what 3.5% yields on the 10-year would do to the extremely overvalued stock market, specifically the tech, growth, and momentum stocks, trading at 10 plus price to sales ratio? But rest assured, with all of this inflation and labor shortage crisis, which we know for sure will destroy the market and the economy, Barclays says buy the dip. Don't worry about inflation. Don't even pay attention. Put your blindfold on and buy. Continue to gamble at the casino. Continue to indulge that you're going to win the lottery. Meanwhile, the next step is off a cliff. Moving on to the Taiwan issue, which is becoming extremely alarming, by the way. We have the highest tensions between China and Taiwan in 40 years. And this is a problem that the market is ignoring for now. China will not do anything, Taiwan will be fine. This is the assumption, of course. But how do you know that Xi will not do something crazy here? Of course, we got a sigh of relief yesterday when we got the news that the Biden administration is planning to meet with President Xi Jinping. And right away, we climbed the wall of worry when it comes to China. And we saw Chinese stocks blasting higher today in a massive short squeeze. On top of that, we got the news that legendary investor Charlie Munger, perhaps the most astute investor of all time, is buying the dip in Chinese stocks, specifically Alibaba. So we have a lot of confidence here in perhaps an upcoming recovery in Chinese stocks. And maybe the relationship between China and the US will get a lot better. But there is still the problem with Taiwan. Of course, President Biden came out last night and he said he talked to Xi, and they agreed to abide with the Taiwan Agreement.
As I've spoken with Xi about Taiwan, we agree we'll abide by the Taiwan Agreement. That's where we are, and we made it clear that I don't think he should be doing anything other than abiding by the agreement.
The problem is there is no such thing as the Taiwan Agreement. When Biden was telling Xi about the Taiwan Agreement, come on, man, you know the Taiwan Agreement. You know the thing? And President Xi was, what the f*** is this person talking about? Because there is no Taiwan Agreement. There is the Taiwan Relations Act, which was back in the 70s, by the way, and it pretty much says that the U.S. will allow Taiwan to defend itself, and that includes selling weaponry to Taiwan. But it doesn't acknowledge the sovereignty of Taiwan. Matter of fact, it acknowledges the One China policy. And that, of course, pleased President Xi Jinping. But the Taiwanese got caught by surprise. What's going on here? Never mind the French being livid right now against the Biden administration, feeling that they got stabbed in the back from the deal with Australia regarding the submarines. Now we have the Taiwanese being absolutely terrified that the world will abandon them. And if the world does indeed abandon Taiwan, there is a massive price to pay, and it ties up with inflation. And I will let the Taiwanese foreign minister explain that to you from a recent interview with Australian TV.
You say that Australia would stand up for Taiwan, but would you seriously expect that Australia would defend Taiwan, put troops on the ground in the event of an attack from China?
That is a hypothetical question.
But so that may not be a hypothetical question. You've said that you fear an attack and that you're preparing for an invasion. So again, I ask you, would Australia be expected to fight alongside you?
It's our policy that we would defend ourselves by ourselves. Taiwan is absolutely committed to defend itself. So whether there's going to be a war or not, we will continue to strengthen our defense capabilities in safeguarding our own democracy, safeguarding our own sovereignty. So that is the bottom line.
Now, he's going to talk about Taiwan's relationship with Australia. So I'm going to skip that, but notice what he's about to say next and how it ties with inflation.
In the absence of war, We see that Taiwan and Australia are great partners. We share the same value. We believe in freedom and democracy and rule of law, and we also believe in free and open and peaceful, stable and prosperous Indo-Pacific. And in this region, Taiwan and Australia are great partners, and we also trade with each other substantially. And that is also putting Taiwan and Australia in the same interest. Other than that, Taiwan is a significant bastion for the production of computer chips. And if Taiwan is under attack, I'm sure the world is going to feel the impact.
Bingo, bingo. The world is already suffering from the chip shortage, and we know that Taiwan is the largest producer of chips in the world. If Taiwan is disrupted, then the chip shortage will get a lot worse than it already is, and China will have a monopoly over chip production in the world. Of course, the Taiwanese are terrified by plans from the Biden administration to start producing chips domestically in the United States because it makes Taiwan obsolete. But for the time being, any disruption to Taiwan, an invasion, a takeover, will disrupt the global semiconductor supply chain and make the inflation problem even worse.
When you say that you would successfully defend yourself, the reality is, isn't it, that you would be massively outgunned. China has the biggest army in the world, the biggest navy in the world. It's continuing to pump more money into its military year on year. How could you possibly win a war against such overwhelming odds?
I think that might be a wrong assessment. Our military is quite capable. It's not like Afghanistan at all. Taiwan's military, even though is being described as having a significant gap with the Chinese military, but we are not totally defenseless. We also have our own navy. We have our own air force. And we have also prepared asymmetric strategy in dealing with China. And we also produce our own defensive articles. I cannot elaborate on that. And I'm sure if China is going to launch an attack against Taiwan, I think they are going to suffer tremendously as well. So that is our commitment. We are willing to defend ourselves.
And lastly, in my commentary, I want to talk about this. Who should be leading the Fed right now? We know Senator Warren, has problems with Chairman Powell, and the likelihood is a senator with a huge weighting like Elizabeth Warren. If she opposes Powell, the likelihood is Powell will not be renominated, regardless of what Biden and Wall Street want. So who is the other choice, the alternative? Is it yet another Fed insider, like Governor Brain Dead, for example, or Atlanta Fed Boystick? That doesn't make sense at all. They are not the change that we deserve. We need responsible monetary policy once again. We need rationale. We need sobering rationality, even if it comes at the cost of the stock market of Wall Street. But we need to save the economy. But we need to address the immediate issues facing the economy and average families, not the elite, the 1% over at Wall Street. On the other hand, economist Mohamed El-Arian has been ahead of the curve from the get-go, warning over and over and over about this inflation crisis and the fact that the Fed is behind the curve. Mohamed El-Arian also displays understanding of the problems with the wealth inequality gap and the massive assets bubble in the equities and real estate market. It doesn't matter if Wall Street like him or not. What matters is he the right individual to lead this organization right now? The answer is yes, and he is an example to illustrate that Mohamed El-Arian understands the problem way better than any sitting Fed president that we have right now.
I have to say there's growing disquiet, I think, that perhaps that inflation and higher prices not looking quite as temporary as policymakers keep telling us. How concerned are you?
I am concerned, and I've been concerned for a while.
Yeah.
This is not to say there aren't transitory factors, meaning they are temporary and quickly reversible, but there also are longer-term issues that are going to last into next year. And as you just pointed out, Julia, people are already changing behaviors. The minute you talk about behavioral changes, it tells you that these are not transitory inflation trends. And the next one, unfortunately, is going to be more companies feeling confident that they can pass on the higher cost into higher prices.
Yeah, changed behaviour starts to look far more sticky than temporary. Is it too early to be discussing, I'll say the word stagflation? We're talking a lower growth environment with higher prices.
Of course, everybody's worried about saying the S word, the stagflation word, as it forbidden or something. We've been saying the stagflation word in this channel from the get-go, from the beginning of the year. The current reckless policy from the Fed will lead us eventually to a stagflation crisis like we have never seen since the 1970s. And now even the mainstream media is using the word stagflation.
It's not too early to discuss it as what they call a tail risk. Relatively low probability, high impact. Is it too early to talk about it as a baseline, as something that has a more than 60 or 70% probability of happening? Yes. There is no reason why we should trip into a stagflation. There are stagflationary wins, but if our policymakers respond quickly enough, they will die down.
You say the deciding factor is going to be policy decisions, global economic policy decisions actually in the coming weeks. Is that fiscal, monetary, or both? Be specific about the real risks here.
Happy to be specific. We need three policy responses. Number one, at the Fed, they need to ease their foot off the pedal to the metal monetary policy approach. They are putting in way too much liquidity. It's causing a liquidity overhang. It also is causing asset prices to disconnect. Look at housing as a perfect example. Do we really need the Fed to buy 40 billion worth of mortgages every month when a lot of Americans are being priced out of the housing market? The answer is no, but they keep on doing it. So number one is the Fed easing its foot, not slamming the brakes, easing its foot off the accelerator. Number two, pro-growth initiatives. I think what the Biden administration is proposing in terms of physical and human infrastructure is really important. And number three, something that's hardly ever discussed, more prudential supervision of the non-banks to make sure that we don't get a market accident. If you do all three, you have an orderly path that avoids both persistent inflation and the stack side of stagflation.
And when Mohamed El-Arian is asked, what about the devil's advocate here? Let's see it from Jerome Powell's side. If he tightens now, he risks destroying the economic recovery. He risks disrupting the economic recovery. And Mohamed responds right away with rationale, facts, and logic that the Fed's policy already failed, and therefore continuing with this failed policy is absolute insanity.
So that is the view, but Julia, if I may, I completely disagree with that view.
Yes,
it's wrong.
Please.
It's wrong, first of all, because they are not benefiting the economy. They are benefiting asset holders. And they are creating asset inflation, which is actually harming bits of the economy and creating a higher risk of financial stability. That's number one. Number two, they can't do anything about supply constraints. So continuing to pump in liquidity is not going to help the ships move across the oceans. It's not going to reestablish all sorts of supply chains. I think we've gotten to the point where most economists agree there are very few economic benefits of this pedal to the metal approach, and the costs and risks are mounting every single day.
Mohamed El-Arian also displays his understanding and acknowledgement that perhaps one of the biggest risks we're facing right now, not just in this country, but globally, the rise in income inequality and wealth inequality. The gap is the widest in modern human history. We have never seen the rich becoming so rich while the poor gets poorer and the middle class disappears right before our eyes. This is not America. This is not capitalism. This is gangsterism, and it will morph into a massive national security issue when you have people poor, hungry, and having nothing to lose. These are the same conditions that we had back in Russia in 1917. The wealth inequality problem is not just between individuals in the United States, between different classes, but it is also between countries, wealthier countries and poorer countries. We have a massive crisis, the biggest economic crisis right now in Lebanon's history, for example, with the energy crisis and grains prices rising higher out of whack. The current policy from the central bank of the world is disrupting the global world order. For example, we have an energy crisis over at the European Union. Absent of an alternative, countries like Germany, for example, will have to accept and bow down to the generosity of Russian President Vladimir Putin, who is now seizing the opportunity to pump the European Union with much needed gas. The Europeans are sick and tired of waiting and waiting and waiting for us to extend help to them and solve the energy crisis. And therefore, they're accepting aid and the approach from the Russian President Vladimir Putin. It is a social story. It is a socio-economic story. And it is a geopolitical story. And Mohammed Al-Arian understands the issue precisely.
I think the thing that worries me the most is inequality both within and across countries. And it's something that the financial markets puts aside as a social problem, not really an economic or financial problem. And we risk seeing the issue of inequality gather momentum. COVID has already been the great unequalizer. But rather than go back to where we've come from, we are now creating the dynamics for inequality to worsen and to assume greater importance in disrupting all sorts of things in our society.
Well, let's dive in a little to maybe some of the places that you see it most striking that may worry you the most.
So, of course, we see it in income and wealth, and that has massive economic consequences. A highly unequal society is not an economic healthy society. But the one thing that worries me even more than that, and I'm already worried about income and wealth inequality, is the inequality of opportunity. We know what COVID did to people who had no Wi-Fi at home, who had no computers. We know that school districts, public school districts, lost touch with a lot of their students. And these students risk not only becoming unemployed, but unemployable, which means a lost generation of young people. We're also seeing the aftermath of COVID as we slowly emerge from it, create different dynamics around the world. If you're sitting in a developing country today, you can no longer assume that companies will come to you. The onus is increasingly on us coming to our employer. And that is a real issue when education is lagging, when technology is lagging. So I do worry that we're going to see this massive process get larger if we're not careful.
Do you think that this was a process that was starting long before COVID and exacerbated by COVID? And if so, what was it about COVID that made us much worse now than we were before?
Yeah, I mean, think of we were watching a tragic movie in play mode, and then COVID came along and pressed fast forward.
Anyhow, folks, we're done with the commentary, and let's move on to the markets coverage today. And here we go. The Dow Industrial Average closing in the green by 337.95 points, or a gain of 0.98%. The Nasdaq closing in the green by 152.10 points, or a gain of 1.05%. The S&P 500 closing in the green by 36.22 points, or a gain of 0.83%. And here are the sector's performances for today. Leading the pack at number one, capturing the gold medal, consumer cyclicals. And of course, this is due to the rise in Chinese stocks, the massive rebound. Chinese stocks happen to be a large component of consumer cyclicals, and therefore we have it at number one. But here it is at number two for the silver, materials, and number three for the bronze, technology. And the only laggard today is utilities. Rates are rising higher, utilities and rates underperforming. Of course, you cannot validate the rally in tech when you have yields surging higher, and therefore we're not going to have a legitimate bottom. This is not over yet until yields and the dollar start to cool down. And what about the advance to decline ratios? NYSE 75% advancing versus 22% declining. The Nasdaq 71% advancing versus 25% declining. Yesterday, the ratios were depressed, indicating weakness in the market and perhaps buying of big cap technology stocks. But suppressed ratios always come with a tradable bottom. And now we're reaching 75, 80, perhaps we'll get to 85, and that will mark a tradable top. Moving on to futures, what's going on here? A massive rise across the board. We're seeing energy prices relentless rally, regardless of where the dollar goes, regardless of the rescue operation from Vladimir Putin last night. Energy prices continue to rise higher and higher and higher, regardless of anything, even the fact that we have higher inventories now. And it will not stop. It will continue to go on and on and on. because inflation is always a monetary phenomenon. And in the later stages of inflation, when we get to stagflation, you want to be in energy. Energy prices will continue to rise higher at a whack. We're going to have pauses and massive drops, but in the long run, until the reckless monetary policy is addressed, energy prices will continue to rise higher. We have gains of almost 2% apiece, both the WTI and Brent. And then we have natural gas prices rebounding higher, a little over 1% today. And who knows if they're going to continue to rise higher and higher and higher. Janet Yellen says we're running out of cash. The country is running out of cash. You know what else we're running out of? America has just 31 days of diesel supplies available as winter draws closer. This is going to be one expensive winter, and it's going to be destructive to the poor and the middle class. And the homeless population, by the way. We have an eviction moratorium that expired, but we have the homelessness crisis growing by the day. We're going to have people dying in the streets in the United States of America. It's not new, but it's going to get worse. What about softs? Remember the transitory lumber. Lumber popping higher by more than 6.5% today. And we have gains for coffee, cocoa, cotton, and sugar futures, all rising higher. The only decliner here, OJ futures down by a little more than 2%. What about metals? Gold underperforming, down slightly. Meanwhile, we have modest gains for silver and platinum, while we're seeing sizable gains for copper and palladium futures. And what about meats? We have big gains for live and feeder cattle futures, and even lean hogs futures, also bouncing higher by about 0.5 percentage point or so. And by the way, you might have noticed the rise in bacon prices. Bacon becomes latest victim of supply chain disruption. Inflation. Within the consumer price index, the component for food at home has risen 6 months in a row and is up 2.6% this year. You might have noticed that bacon prices are surging out of whack. And you might say that this is perhaps good. We're going to switch from meats to perhaps more vegan choices like Beyond Meat, for example. Hold your horses here, because even pea prices are surging out of whack. Beyond Meat supplier warns of higher pea protein prices. So there you go. Pretty soon we're not going to have anything to eat at all. But what about grains? Massive gains for oats. I've been long oats since last year, and it will continue to surge higher and higher and higher. And the reason is we have the worst crop since the 1800s. Once again, the worst crop since the 1800s. When we say prepare for mass starvation, we're not joking here. Natural gas prices surging higher. What do you think is going to happen? Fertilizer prices are also rising higher. When fertilizer prices rise higher, grains prices rise higher. When grains prices rise higher, food prices rise higher, and your grocery bills will also rise higher. It is a ripple effect, and the Fed is responsible for this crisis. We also have gains for soybean oil, rising higher by almost 3% today. I'm long soybean oil too. We have modest gains for soybeans, corn, canola, and rough rice futures. Meanwhile, modest declines for soybean meal and wheat futures. Moving on to the big casino, the options market. What's going on here? Coming up, number one, the hottest table in the casino is Tesla. With about 1 million contracts, about 50% of those were calls. Of course, we got the conference call, whatever it is, between Reverend Elon and Tesla investors. And the biggest headline so far is moving the headquarters from California to Austin, Texas. But besides that, we had a lot of optimism here buying calls. But the likelihood is, if the stock market goes down tomorrow due to a hot jobs report, then Tesla will witness buy the rumor, sell the news. What about Apple at number two? With about 990,000 contracts, about 63% of those were calls. And here it is, Alibaba at number three. With about 700,000 contracts, about 63% of those were calls. They're buying a lot of calls here. The optimism about the meeting between Biden and Xi. And then you have Charlie Munger also buying the dip. We're about to see a massive short squeeze if this momentum continues in Alibaba. Moving on to the unusual trades that took place in the options market today. Starting with the ticker VST. This is for a company called Vestra, an electric company, but it's also a quasi-bet for natural gas and coal, since the company transports these commodities. Although this time around they're betting for a top here. by buying the 17 puts for the expiration date November 19th, with the expectations that the name will drop down by more than 5% or so. They paid about 50 cents apiece to enter this trade, all in all spending about $1 million. What about the trade for the ticker LQD? This is the ETF with the investment grade bonds. They're buying puts here, very interesting bet by the way, the 125 for the expiration date November 19th, with the expectations that the name will drop down by more than 6% or so, and they paid about 25 cents apiece to enter this trade, all in all spending about $300,000. And what about the ticker PAGS? This is a Brazilian company. It is down big, but perhaps we're seeing a bottom here, and they're bidding for more gains to come and build on off the rebound. They bought the 47.5 calls for the expiration date October 15th, with the expectations that the name will pop higher by more than 5% or so, and they paid about 65 cents apiece to enter this trade, all in all spending about $700,000. And what about the trade for the ticker AMZN, Amazon? Very interesting. They're buying calls here, the 3,550 calls. The expiration date, October 22nd, with the expectations that the name will pop higher by more than 7.5% by then. They paid about $5 apiece to enter this trade, all in all spending about $5 million. What about the trade for the ticker PDD, Pinduoduo? Rebounding higher along with Alibaba, JD, NIO, Li Auto, all of these Chinese stocks. We have seen rebounds before. Is this different, or are we about to catch a falling knife once again? We'll see. For now, they're buying calls, the 109 calls for the expiration date, October 29th, with the expectations that the name will pop higher by more than 15% or so. They paid about $1.25 apiece to enter this trade, all in all spending about $1 million. And here it is for the ticker BABEA, Alibaba. They're buying the 165 calls for the expiration date October 29th, with the expectations that the name will pop higher by more than 6% or so, and they paid about $4 apiece to enter this trade, all in all spending about $2.5 million. What about the trade for the ticker LMND, Lemonade? They're buying calls here, the 75 calls for the expiration date December 17th, with the expectations that the name will pop higher by more than 14.5% by then. They paid about $4 apiece to enter this trade, all in all spending about $2.5 million. We are skipping the heat map analysis, nothing new here. The tide that lifted all boats, the technical rebound. For now, of course, the confirmation will come out tomorrow as we get the payroll report. For now, we're moving on to the charts analysis, starting with the SPY 30 minutes chart. Gapping higher in the morning, as expected by the way, off the reverse head and shoulder formation, and the SPY managed to recapture 438 for support. The problem is the algos did the buying in the morning and the human being sold the rip by the end of the day, and the SPY closed at the lows of the session, even though it closed positive for the day. The other problem is the SPY failed to close the gap at around 443. What's going on here? Do we have the energy and the buyers to push the chart all the way to close the gap, or is this just another false breakout higher? It's the battle of the gaps. We have a gap higher, or we have a gap lower. Which one will it be? One of these gaps will be closed tomorrow. Will it be up? Will it be down? Let me know in the comments, but my opinion for now, we have overbought conditions from an RSI perspective, indicating that the chart should cool off for a little while, perhaps going down to close the gap below, not the gap above. We'll see. Here's the daily chart for the continuous contract in the SPY, again pushing its way higher, closing pretty much at the line of 4,384.5. Slightly above, job well done for now. The momentum indicators are strengthening. We have an imminent crossing in the MACD indicator, and the RSI is bottoming already. All of these are positive signs indicating that on the daily, the chart should continue to pop higher until it finds resistance. The problem is, what if today was the resistance? Because we have a sloping resistance line. The answer for this mystery will come out tomorrow. And what about the NASDAQ 30 minutes chart, also gapping higher off the reverse head and shoulder formation and recapturing not just 360.5, but 363 for support. The problem is the chart went all the way to the resistance of 365.5. It didn't have the energy to continue to build on because the algos bought in the morning. The human being did not buy. The human being sold by the end of the day. And this is quite problematic. The majority of the market is interested in gambling in options. For example, what did market participants do today? They bought call options on Tesla and Chinese names. We have a very short scope in the market right now when it comes to market participants. We have a lack of clarity and lack of conviction, and therefore we're seeing short-term trades and no high conviction buying. You have to keep in mind, how would the Qs continue to rise higher and higher and higher when yields are also popping higher? It doesn't make sense at all. It was an oversold rally, and now we're already overbought from a 30 minutes perspective on the RSI. If the report comes out hot tomorrow, the likelihood is yields will pop higher and the Nasdaq will reverse to the downside. And here is a daily chart for the continuous contract on the Nasdaq. What's going on here? The momentum indicators are looking good. We have an imminent crossing in the MACD, and the negative divergence on the RSI is already reversed. Moreover, the chart went all the way to the resistance of 15,000. It gave it a shot and it didn't happen. And the likelihood is it could give it another shot, but do we have buyers? Do we have a confirmation from yields that we should start buying the dip in technology? Of course not. For now, we don't have the confirmation. We could get that tomorrow, but for now, we don't have any confirmation. Of course, the bulls are hoping to crack above 15,000 at one shot. But even if that doesn't happen and the market dips below, the bulls would be eyeing an ABC pattern to once and for all break above 15,000. So we have a contrast between the 30 minutes chart and the daily chart. The 30 minutes suggesting a pullback, the dailies are suggesting a continuation of the pop and rebound higher. And what about the IWM 30 minutes chart? What's going on here in small caps land? Also gapping higher and recapturing 223 for support. Is this good or is this bad? It is good. The problem is the momentum indicators, the RSI, are already oversold, and therefore the likelihood is we will see a pullback. The test remains for the IWM. Can you close above 223 for the week? Let's say the chart gaps down tomorrow for whatever reason, and then we see dip buyers, and the IWM closes above 223. We have a confirmation of the strength here. Absent of that, a close below 223 will indicate that the IWM remains in no man's land. What about the Dixie? What's going on here? Muted today, and this was good enough for the inflationary trade to rise higher. In industrials and materials, the commodity-related stocks, the likes of Freeport-McMoran, Alcoa, all rising higher. All what the dollar has to do is consolidate and cool down. We're not asking for a crash. We're not asking for a massive pullback. We're asking for a cooling down in the momentum. The problem is, when it comes to the US dollar, is what we're seeing right now an ABC pattern. And if it is, then we have another leg higher that could take us all the way to 95. But what about gold? What's going on here? Still hugging the Fibonacci support, fighting over and over and over again. For now, I'm keeping my bull flag intact. Perhaps gold will surprise us by popping higher. But for now, I remain skeptical because the dollar and yields continue to move higher. This is not a good environment for gold. Mind you, Bitcoin, tulips, also rising higher. Remember that gold has three enemies: the dollar, the 10-year yield, and Bitcoin. When all of these are rising higher together, this is the worst environment for gold. But on the other hand, the resiliency of holding and holding and holding is impressive. And therefore, I am debating, is gold for real here, or will gold fall apart when buyers fail to show up? Moving on to the 10-year Treasury yield. What's going on here? A massive update, and therefore, forget about any rally in technology. You cannot confirm any rally in tech, momentum, and growth with yields popping higher like this. For all we know, this is an ABC pattern that will take us all the way to 1.7. If we go to 1.7%, forget about the tech and the momentum stocks. They're gonna crash again. And here's a chart for the TLT, weekly chart. What's going on here? The big day, the last day of the week. If the TLT closes at these levels, then we have a confirmation of the weakness. We have a crossing in the MACD and a negative divergence on the RSI, and oh, by the way, the volume is rising higher on down weeks. What does that mean? Perhaps we have a massive pop in yields, which will catch the market by surprise and resume the pain once again. What about the VIX? It was tricky for a little while here. From a 4 hours perspective, looking at the MACD, will it cross up or down, zigzagging, back and forth, back and forth? We now have a confirmation that the VIX is trading below 20. Right away overnight, looking at the chart, you knew that the SPY is about to pop higher. The real test now is crush the VIX Fridays. Are the bulls about to crush the VIX again? And if they do, then we have a confirmation that we are indeed in a bottom right now, and we should at least play the pop higher, the rebound higher, whatever you want to call it. However, if the bears succeed once again in popping the VIX to close weekly above 20, then we got a problem, and this is merely a dead cat bounce. Moving on to Apple, what's going on here? Popping higher, the MACD is starting to look good. The RSI is starting to bottom, and the real test is closing the week above 145. The problem when it comes to Apple is the weekly chart. It remains weak. We have a negative crossing on the MACD indicator. So whatever gains in the daily, that would not matter if we don't have a repair job on the weekly. And the repair job will happen if Apple closes the week above 145, preferably above 150 by the end of the week. I'm not calling for 150 for now. You need 2 weeks for that. But I'm watching 145. If Apple starts to move higher, closing the week above 145, then perhaps we will see the repair job on the weekly. What about Tesla, the souffle? What's going on here? 30 minutes chart, we had a sloping descending line of resistance, which was broken to the upside, and now we have an ascending line of support. Of course, the funny business happened midday. As you can see, the massive green candle, the pop higher, which is, by the way, in my opinion, the Tesla whale, whoever that is, they used an interesting strategy. They bought a ton of the 800 calls, which, by the way, they've been holding for a while, but they bought a little more today. And then they bought block shares of Tesla to pump the stock higher and dump the calls at a massive profit. And now the risk versus reward is, what if we have buy the rumor, sell the news, and Tesla drops tomorrow? Well, you're not going to lose money on your call options. You already closed them at a profit, and the losses are limited to whatever percentage Tesla trades down to. And they could do that, by the way, in the aftermarket. Tesla's down about 0.5%, nothing big. They made a killing from the 800 calls, which they closed right away because the open interest is down big. And they dumped the shares that they used to pump the call options in the aftermarket with a loss of about 0.5 percentage point. Nothing big at all. And of course, we have calls that Tesla will reach 1,000, 2,000. You gotta buy here. Wedbush, Dan Ives, the super cycle, says buy Tesla now. Yada, yada, yada. The truth is, the rise of this stock came on the backs of shorts. It is the house that shorts built. They started shorting Tesla aggressively as Tesla was close to bankruptcy. And of course, they failed because why would you short a company? Because they're low in cash. We are in the cocaine era. Cash is cheap. Cash is not a reason to short a stock. And therefore, they got caught with their pants down, and we saw perhaps one of the biggest short squeezes in stock market history. So Tesla has been rising primarily on short covering, but now the short float is down to 2%. There are no shorts left to boost the stock higher. So what will be the catalyst for this name to continue to move higher while it is already one of the most overvalued stocks in the market right now?Moving on to BTC, tulips. What's going on here? We're getting a little overbought from an RSI perspective. The chart is facing the resistance at 55,300. Nothing big here, just a pause. The problem is if we see profit taking from cryptos and moving that money to buy the dip in stocks. And lastly, what about the chart for AMC? The bull flag is playing for now, and perhaps we're about to get a crossing in the MACD on the daily, and therefore there is the potential, we still have the possibility, that AMC will rise higher and it could close above 42.5. It could rise all the way to 52 even. If the market rallies and we see yields down, the dollar down, the momentum back in the market, AMC could rise higher. The problem is the weekly chart remains weak and it remains ominous, not just weak, but ominous. And moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? The big day, the big report, the payrolls from the BLS, the cooks are going to be busy. Busy doing what? Giving us a cold number. The expectations are 500,000. If they go 400, 300,000, it will be alarming and perhaps not believable because we have the ADP rising higher. So it's going to be a tough job here. If the cooks give us 500,000, 600,000, 480,000. This is the sweet spot to keep the debate going. Is this good enough for substantial further progress to initiate tapering or not? However, if the cooks fail and the number comes out too hot right out of the oven, perhaps too many onions, right? We're going to have a problem because if we get 800,000, for example, then watch out here, pal. Perhaps we're getting to substantial further progress and then some, and therefore tapering perhaps is not going to do it. You're going to have to do aggressive tapering, not a gradual one. And this will not be good for the stock market. All eyes on the big number tomorrow. And with that, ladies and gentlemen, I'm done here. Thank you for watching. Thank you for listening. This is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.